welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Wednesday afternoon, we have Ryan McCormack, factor and core equity strategist at Invesco, to discuss Nasdaq-100 weekly performance. Of course, we have to touch on inflation, which that data has certainly been key, Ryan. And I think really the story of the week, or the story over the past couple of months, has been the reversal that we've seen in the Nasdaq-100, despite the higher inflation levels that we're seeing.
Yeah, I mean, that's for sure. And, we've seen a pretty solid rally here off of the lows that we saw around mid-June. And this week was no exception to performance that we've seen over the past 2 months. QQQM was up 4.84%, QQQ up 4.83%, both of which outpacing the S&P 500 up just under 4.5%, and the S&P 500 value up 4.11%. But, a good week for stocks all around on inflation reports that were largely viewed, pretty positive. The first one, we saw the July CPI reading. It was reported on August 10th. It cooled to 8.5% year over year. So that's down from 9.1% in June and better than the consensus estimate for 8.7% year over year growth. The month over month reading was flat. And then within the core reading, which strips out kind of the more volatile components, food and energy, it came in at 5.9%, equal to the June reading and better than the consensus estimate of 6.1%. So, kind of going along this narrative that maybe June was the kind of signal for peak inflation. And then we kind of saw a continuation of that on Thursday. It brought the release of the producer price index, the PPI, and the first month over month negative reading in around 2 years, with a decline of 0.5%. And that compares to the June reading of a 1.1% advance and better than the estimates of a 0.2% advance. So within the chart that's on the screen, right, it's showing 5 years of CPI and PPI. And you can very clearly see the dramatic spike higher. It was beginning in late 2020. The lines from there have basically been straight up until a tiny little retreat that we've seen at the end of the chart. And that little retreat is what the market has been hyper focused on and hoping that it signifies the retreat from peak inflation in June for CPI and March for PPI. And then lastly, on Friday, we saw the release, the preliminary reading of the August University of Michigan Consumer Sentiment Index, climbed to 55.1, so well above the previous reading of 51.5. Prices have been of particular focus in the report, as the Fed has referenced the indicator during some of their minutes and meetings. The longer term price expectations within the reading ticked up to 3% per year for the next 5 to 10 years. That's up from 2.9% in the previous report. But on the shorter end, consumers are expecting price increases to moderate a little bit, to grow about 5% over the next year versus the last reading's expectation of 5.2%.
Yeah, Ryan, it's really interesting because it seems as if stocks are trading on an easy Fed just by looking at the activity since mid-June. And of course, earnings does contribute to some of the momentum that we've seen. But I want to get your thoughts on the FOMC minutes that were just released this afternoon at 2 p.m. Eastern. It doesn't appear that the Fed is easing at all. I mean, their mandate is to get inflation over control. And while we have seen a retraction in inflation data, it's still over 8%.
Right, exactly. I mean, we're still very elevated, right? But I think it's the market has been very forward-looking in that, right? They're looking for a more dovish Fed, and I do think, right, a combination of earnings and sort of where we were from a valuation standpoint has certainly helped fuel this rally. But the release of the minutes today, I think one of the main takeaways is that the Fed had discussed slowing the pace of rate hikes after assessing the impact of their prior policy adjustments in the economy and in regard to inflation. The minutes did kind of mention that the FOMC is watching the lagged effect of monetary policy and with that possibility of tightening policy by more than what's needed. to restore that price stability. So it's a little bit of a tightrope, right? I think one interesting quote on the other side was participants judged that a significant risk facing the committee was that elevated inflation could become entrenched if the public began to question the committee's resolve to adjust the stance of policy sufficiently. So that kind of talks about the back-to-back 75 basis point hikes, kind of like, making sure that Fed credibility is there in the market. But it appears that some of the concerns that are on investors' minds are also acutely on the FOMC's mind as well. Fed funds futures after the release, little change today from yesterday. The first rate cut is expected in May of 2023. Before that September meeting, which is the next time the Fed will meet, we're going to get a look of August CPI figures, see if that inflation kind of continues its moderation. And today we've seen the Nasdaq 100 kind of jump off the lows of the session upon the initial release of the minutes and have since retreated a little bit. But again, they're off the lows of the session.
Well, I mean, certainly Apple helping the Nasdaq 100, that's for sure. And Ryan, to wrap up here, when we take a look at sectors, what has been attributed to the performance here?
Yeah, so again, a good week for stocks. I mean, all sectors within QQQ and SPY finished the week in positive territory. Best performing sectors in QQQ were consumer discretionary and technology, up 6.17% and 5.10% respectively. Tesla was the largest contributor to the discretionary sector, while NVIDIA, advancing by over 10%, was the biggest contributor to relative outperformance versus SPY and tech. And that's despite kind of the release of its preliminary revenue figures that missed analysts' expectations.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.